Hi friends, welcome to the channel JIB and CIB Made Simple. In this video, we are going to discuss ABFM December 24 memory based question. As you know very well, previous year question plays a very important role in understanding what are the important topic which we must focus on. So in this particular session, we are going to discuss 20 to 30 most important questions that have been asked in December examination, also including both numerical as well as theoretical, and this will help you gauge which topic are super important for your ABFM examination, upcoming ABFM examination. So try to solve this question on your own first and then listen to the explanation. So let's get started with our first question that we have. Friends, this question is that a firm will pay a dividend of ₹4 next year and the dividend will remain the same for the coming year. An investor expect a return of 16%. What is the fair value of the share? Exactly same question was asked. So this is a classic case of valuing a stock using a perpetuity formula, right? So there is a formula which we call perpetuity formula, and this is the classic case of valuing a stock. First of all, try it yourself and let me explain the formula. The formula is P naught is equal to D1 upon R minus Z, and I think you must be familiar with this particular formula, right? So in this case, what does D1 represent? So D1 represent dividend next year. D1 represent dividend that will happen next year, right? So what is the dividend next year in this case? As you can see, ₹4. So ₹4 is the dividend next year. What does R represent? R represent the required return. R represent, how much return is required. What is required return here? So required return is 16%, or we can say 0.16, right? And what does G represent? So G represents the growth rate of dividend, right? So what does G represents? G represents the growth rate of dividend. Means with what rate the dividend is growing. So G represent growth rate of dividend, right? So can you tell me what is the growth rate of dividend in this case? It is 0%, because the dividend remain the same every year, because it is, you can see clearly written here, dividend will remain the same for the coming year. So this gives the highlight that G will be equal to 0, right? Since dividend remain the same for the coming year, so G is equal to 0. So our formula will become D1 upon R, right? So now you just substitute the value. So D1 is the value of dividend that will happen in the next year. So what is the dividend next year? It is nothing but ₹4. And what is R? Return is how much? 0.16. So if you do the calculation, the answer will be how much? The answer will be ₹25, right? So the correct answer is option number B, that is ₹25, right? So friends, let's also understand why other options are incorrect. Option number A say ₹20. ₹20 is wrong answer. Why? Because has the required return been higher than 16%, the prices would have been lower. But in this case, using 16% as the required return, the value is 25, not 20. So what we learned from this discussion is that always use the perpetuity formula, which is P naught is equal to D1 upon R minus Z. So D1, that is the dividend, D1 is stay constant, right? And it means growth rate is equal to, if the dividend, try to understand, if question is written, if the question it is written that dividend stays constant, so dividend stays constant, what it means? It means that growth rate is equal to 0. Remember, so you see this keyword, dividend remain constant, it means Z will be equal to 0, right? And one thing you can see, if R increases, it means if required rate of return is higher, it means P naught will be lower, because they are inversely related, right? So if required rate of return is higher, so fair price will be lower, and the final answer to this question is ₹25. If you found this explanation helpful, don't forget to like, share and subscribe this particular channel. Now let's see the next question that was asked, and this is the explanation part. As you can see, friends, the next question which was asked in the December examination is it's about the hybrid security, right? So which of the following is not an advantage of the hybrid security? So the first option, hybrid security generally offer a higher rate of return than the debt. Option B, hybrid security shows less volatility in the market price due to regular predetermined returns. Option C, hybrid security have a strict definition as either equitable security or debt security. And option D, hybrid security can diversify overall risk for the issuer. So friends, before we dive into the option, let's first understand what hybrid securities are. So hybrid security are the financial instrument that have both the feature of equity also, and they have the feature of debt also, right? So when I say equity, it means stock, and whenever I say debt, it means bonds. So they have feature of both the thing. So you can think of them like a hybrid car. It uses both petrol as well as electricity. Similarly, hybrid security take characteristics from both stock and bond. Now let's go through each and every option. Option number A suggests that hybrid security generally offer a higher rate of return than debt. What do you think about it? So this is true. Hybrid security often provide a high return as compared to normal debt instrument like bond. For example, a company is issuing convertible bond. Suppose a company is issuing convertible bond, right? Which is it is a kind of hybrid security. It might offer a higher interest rate than traditional bond to attract investor, because investor takes on slightly higher risk, so they get rewarded with better return, right? So convertible bond is a kind of high risk instrument. Option number B, hybrid securities show less volatility in marketplace due to regular predetermined return. Yes, hybrid security, this is also a correct statement. Why? Because hybrid security provide regular interest payment or dividend, which help reduce price fluctuation in the market. For example, if you invest in preference share, suppose you invest in preference share, so you get fixed dividend, right? So you get what? You get fixed dividend. If you invest in preference share, you get fixed dividend. So even if the stock market crash, you will still receive your dividend, right? So unlike common stock where price can go up and down drastically, hybrid security remain relatively stable. What about option C? Hybrid security have a strict definition as either equitable security or debt security. This is wrong, because that is why it is not correct, because hybrid security do not have a strict definition, right? For example, a convertible bond start as a bond but later can be converted to equity. So it is flexible and does not fit strictly into one category. That is why this option is incorrect. Option D, hybrid security can diversify overall risk for the issuer. This is absolutely correct, because company use hybrid security to spread their risk between debt and equity. For example, if company only issue debt, it have a high repayment in debt. So if the company only issue debt, it will have high repayment obligation. Obviously they have to repay, right? And if the company only issued equity, right, so it will also have to it will also cause the dilution of the control. But if it issues the hybrid security, it can balance between interest payment and potential stock conversion. So this help company manage their financial risk better. So what is the answer to this question? Answer to this question is option number C. This is incorrect, and this has been asked. So from what we learned from this discussion is that hybrid security offer high return, right? As you can see, hybrid security offer higher return than traditional bond. So return is higher. The benefit is that return is higher, right? First benefit. Second benefit is that volatility is less. They are less volatile as compared to the because of the fixed return, and also they don't have any strict definition of equity or debt, and they help risk diversification. They help in risk diversification. This is one of the greatest feature. So I hope this explanation help you understanding the concept of hybrid security, right? Let's switch our attention to the next question, and this is this is a numerical question which was asked in the examination. So friends, let's discuss what is the question asking you. So friends, as you can see, the question is a company has invested rupees 10 lakh. So just wait a minute. So it has invested how much? It has invested rupees 10 lakh, right, in a project, and if it earns profit of 1.5 lakh annually per year after depreciation but before tax, right? After depreciation but before tax, right? So depreciation is calculated in the straight line method at 10% per year. So we need to find the payback period for the project. Means how long will it take to recover the entire 10 lakh rupees investment from the net cash flow. Friends, before jumping into the answer, let me tell you, if you are looking for previous year question paper for the last 4 paper which have happened in ABFM or any subjects of CAIIB, you can WhatsApp me on this particular number. We have some paid courses available on our app. App name is CAIIB and CAIIB Made Simple. You will get link of app in the description section. You can install the app and start learning, start getting through the previous year question. They help you clear the insight that which type of question is most probably asked in the examination, and you prepare accordingly, right? So that is what the question concept is. So before jumping into the calculation, let us first understand what is the meaning of payback period. So payback period is the time taken to recover in the initial investment from the cash inflow of the project. For example, suppose you invested rupees 10,000 in a business and you earn rupees 2,000 per year. Suppose you earn rupees 2,000 in the first year, 2,000 in the second year, 2,000 in the third year. So what will be the payback period? Payback period will be 5 years. Why 5 years? Because it takes 5 years to completely to recover this 10,000 amount. So let's first of all do the calculation here. First of all, here the thing is depreciation. How do we account for depreciation? So depreciation, depreciation is a kind of non-cash expense. It is a kind. First of all, depreciation is a kind of expense. It is not a kind of profit. It is a kind of expense. That too non-cash, right? There is nothing cash involved here. right? So it is a kind of non-cash expense. So what we do, we first deduct the depreciation before calculating profit. So we have to calculate the profit, so we have to deduct the depreciation. How to calculate the depreciation? So it is nothing but, how much was our initial investment. So it is, the formula for depreciation is very simple. You just multiply initial investment with, depreciation rate. You just multiply initial investment with the depreciation rate. What is the initial investment? Initial investment is 10 lakh. And what is the depreciation rate? Depreciation rate is how much? 10%, right? So what is the 10% of 10 lakh? It is nothing but 1 lakh, right? It is nothing but 1 lakh per year. So this is the rate at which the project will get depreciated. That means every year the asset loses 1 lakh in value, but this is not the actual cash outflow. Is it the actual cash outflow? No, it is not an actual cash outflow. So first of all, we have calculated the depreciation. Second thing we have to calculate is the cash inflow before tax, right? Before paying tax, what will be our cash inflow? Till now we have not taken the cash into consideration, tax into consideration. So let's just calculate cash inflow, because project has invested obviously. So obviously it will receive some cash inflow. So what will be the cash inflow before tax? How to calculate that? So basically profit after depreciation. What will be the profit after depreciation? After accounting for depreciation. So it is nothing but, so you can see profit is how much? 1.5 lakh. 1.5 lakh is the profit. So after taking into depreciation, you first write 1.1 lakh 50,000 plus you add back depreciation. Why depreciation is added? Because it is a non-cash expense. Because depreciation is only recorded on book, but it does not happen actually, right? Sometimes some residual values are always there. So what we do, we add this 1 lakh. We add this 1 lakh back. So this gives us how much? 2 lakh 50,000. So basically this is the total cash inflow before tax. Now we have to calculate the cash inflow after tax, because everything matters that cash inflow after tax. That is what matter here, right? So how to find the cash inflow after tax? Can you tell me? So we know the cash inflow before tax. So the formula is quite simple. Let me erase the first part here. Let me erase it. Now I will do the calculation here. So cash inflow before tax, we know we have to calculate the tax. So first of all, let's apply the tax calculation. Let's do the tax calculation. So what is the tax calculation here? So as you can see, the tax is how much? 10%. No, 50%. Tax rate is 50%. So it will on the profit. It will on the profit. So 1.1. So tax will be how much? 1,50,000 multiplied by how much? 50%. So what is the 50% of 1,50,000? So 50% of 1,50,000 is how much? 75,000, right? It is nothing but, it is nothing but 75,000. So this is the tax, right? So what will be the net cash inflow after tax? Net cash inflow after tax is equal to, this tax has to be paid by the company. So obviously the cash inflow will get reduced, isn't it? This cash has to be paid by the company. So total cash inflow will get reduced. So earlier cash inflow before tax was how much? 2,50,000, and you reduce it by 75,000, which is the tax which is paid. It will give you 1,75,000. So this is the cash inflow after tax, and this will be used to calculate this is the actual money coming into the business every year. Understood? So how to go about calculating it? First of all, you write the total profit you are getting. You add the depreciation. Why you add the depreciation? Because depreciation is a kind of non-cash expense, right? Non-cash expense, so it is added back. It is just recorded on the paper, but actual depreciation may not have happened, right? So this is a kind of non-cash expense. So whenever any kind of non-cash expense, it has to be added, right? There is no cash portion involved in it. So total cash inflow before tax and depreciation is 2,50,000, and then we separated the tax, we get 1,75,000, right? So we know the cash inflow after tax. Now we have to calculate the payback period. So what is the formula for payback period? The formula for payback period is simple. We just write investment in the numerator, and we just write the annual cash inflow after tax. What is annual cash inflow after tax in the denominator? So in this case, investment is how much? 10 lakh. So 10 lakh divided by 1,75,000. So if you do the calculation, it will be near about 5.71 year. So obviously option A, suppose 5.7, this is the answer, right? So the payback period will be 5.71 year. So I hope that makes sense to you. How do you go about calculating the payback period in the easiest way possible? So this is how we do the calculation of payback period. Now let's shift our focus to our next question, that global foundation. So friends, what we learned from this question is that Payback period means what? Time taken to recover investment from cash inflow. Depreciation is a non-cash expense, so we always add it back. So cash, so one formula you must keep in mind, that this formula will help you remember the thing. Cash inflow after tax is equal to profit after depreciation plus depreciation minus tax. Right, profit after depreciation plus depreciation minus tax. So this is how we go about calculating it. Right, now let's look at the next question. Global Foundation and NGO typically provide finance for green financing project through which of the following method? Very good question it is. So friends, Global Foundation and NGO, our goal is to find what is the correct financing method used by NGO and global organization to support environmental projects. So before jumping into the option, let's understand what is the meaning of this green financing. What is the meaning of this green financing? So it refers to the financial support for eco-friendly project. You know, some projects are eco-friendly. So financial support for the eco-friendly project is called green financing. Like if you talk about some eco-friendly projects, some example I can give you, like just like renewable energy. This is an example. Or I can give you is afforestation. This is an example of renewable project. And climate change solution. For example, imagine an NGO wants to help a village install solar panel. Suppose an NGO wants to help a village to install what we call solar panel, right, to generate electricity. So they need money, they need green financing. And green financing provide them with the fund to execute the project. So let's analyze the option. Option number A suggests bank guarantee. What do you think? So basically bank guarantee means a bank promise to pay a certain amount if the borrower failed to fulfill its obligation. It is not actual money but a backup assurance given by the bank. For example, suppose a company want to build an eco-friendly factory. So bank may give guarantee to pay supplier in case the company fails to do so. So this is incorrect because bank guarantee does not provide the actual money to fund a project. Right. Option B is underwriting. This is also incorrect. Why? Because underwriting is when financial institution take the risk. Right. So whenever I say underwriting when it happen? Underwriting happen when financial institution take the risk. Whenever a financial institution takes risks, right, of funding a project by ensuring it get necessary investment. So this is commonly used in stock market. So this is commonly used in stock market. In stock market, this underwriting is commonly used, right? And bond issue, not in NGO grant. It is not used in NGO grant. Remember. So underwriting is an investment strategy, not a direct way for NGO to finance green project. NGO don't act like investment bank. They provide direct fund, not risk-based financial backing. Option C we have is called project-specific grant. See, what is project-specific grant? You know what it means, project-specific grant? See, basically a grant is a free money given to fund a specific environmental project. It does not need to be repaid. So NGO and global foundation use grant to support projects that promote sustainability, renewable energy and climate action. Let me give you an example. Suppose a foundation donate 50 lakh. Suppose a foundation is there that donate 50 lakh to a city for building a large public park, right? Suppose a foundation donate 50 lakh to a city to build a large public park to improve air quality. So this money is not a loan, it is a grant meant for only this project. So why this correct? Because NGO and foundation prefer grant because they directly support green initiative without expecting financial return. What about equity? So equity means owning a share in the company or project by investing money in it. So investor provide money and in return they get a stake in the business. For example, if a green energy company raise 10 crore, investor may give money in exchange for share in the company. So this is incorrect because NGO do not invest for profit or demand ownership in exchange for funding. They do not demand, right? So the answer to this question is option number C. So what we learned from this question is that green financing fund eco-friendly project like solar energy, afforestation and waste management. Bank guarantee is like a backup assurance, not direct funding. Underwriting, is an investment process, not a donation. Project specific grant is the correct answer. And equity, it means owning share, which NGO don't do. I hope this explanation make the concept clearer to you. What is the meaning of green financing? Let's switch our focus to the next question that we have. The next question, as you can see, very good question. This is most frequently asked. So right. So what is the primary objective of MBO? You know what is MBO? So friends, what is the primary options are to establish vague and flexible goal for better adaptability, to set clear parameter and goal for planning and achievement, to focus solely on employee performance without any goal setting, to eliminate the need for regular evaluation in the management process. What is an objective of MBO? So MBO is a management approach that focus on setting clear goals. It focus on setting, clear goals and working toward achieving them. So the question is asking what is the main purpose of this approach. Option A, to establish vague and flexible goal for better. This is wrong, because it suggests that MBO is about setting unclear and flexible goal so that business can easily adapt to changes. So imagine a company tells its sales team, just try to increase sales, we will see how it goes. Why this is incorrect? Because MBO is not about setting vague goal. It focuses on a specific, measurable and well-defined objective. Option number B, to set clear parameter and goal for planning and achievement. Yes, this is the correct answer. Because MBO is about defining clear goal for employee and organization. For example, a company may set a goal that increase sales by 15% in the next 3 months. Right, this is the goal that company has set, increase sales by 15% in the next 3 months. So the goal is SMART. What is the full form of SMART? This question is asked frequently. Right, SMART means specific, measurable, achievable, relevant and time bound. So this question is frequently asked. What does M stand for in SMART? M means what? Measurable. A stands means achievable. R stand means relevant. T stand means time bound. So MBO make planning and goal setting structured and result oriented. So you can see from a single question we are learning different concept. Option C, to focus solely on employee performance without any goal setting. This is completely wrong. Right. For example, a manager says just keep working hard and we will see how you perform. So MBO is not about just monitoring employee. It is not just about monitoring employee. Rather, it's about giving them clear goal. Option D, to eliminate the need for regular evaluation. No, this is incorrect. Because for example, a company say once we set the goal, we don't need to check progress. So MBO actually require regular evaluation to ensure that goals are being met. Without checking progress, employee may lose direction. So what we learned from this discussion is that MBO focus on setting clear and measurable goal. That is the point. And you must remember the full form of SMART. Right, very, very important. The goal should be SMART. SMART, I think the full form is clear to you now. Now let's look at the next question. So friends, the next question is on your screen. Very good question it is. Let's go through. The question is, how do commercial bank classify their financial exposure to the non-conventional energy-based public utility? Right. So how do commercial bank classify their financial exposure to the non-conventional energy-based public utility? So first of all, you must understand the meaning of this so-called non-conventional energy-based public utility. You know what it means. So these are the large-scale project. There are some large-scale project that produce solar, wind, and or hydroelectric power. Right. Since this project require huge investment, so bank must categorize their loan properly. Option A, mid corporate segment. What do you think about this option? Is it correct? No. Why? Because mid corporate segment include medium sized business. It just include medium sized business which generally have an annual turnover of around rupees 250 crore to 1000 crore. Right, because large energy based public utility need massive investment. So this project don't fit into the mid category, mid corporate segment. Option number B, exposure to large corporate sector. Yes, this is the correct answer. Because large corporate sector include big business or infrastructure project requiring huge funding from bank. So suppose a company needs 1000 megawatt solar power plant. So the project will cost thousands of crore and require funding from multiple banks. So since these projects are big, bank classify them under large exposure sector, large corporate sector to manage their credit risk properly. Option C, exposure to export unit. This is incorrect. Export unit means business that sell goods or services to other country. For example, if an Indian company export solar panel to Europe, it would be classified as export unit. So non-conventional energy project produce electricity for domestic use, not for export. That's why this option is not correct. Option D, export priority sector lending. So basically, priority sector lending is a government initiative where bank must lend a portion of their fund to a specific sector like agriculture, MSME, export. For example, if a bank give a loan to a small exporter selling eco-friendly solar lamp abroad, it may come under export PSL. So non-conventional energy public utility are large exposure project. So what we learned from this discussion is that this kind of non-conventional energy-based public utility, they are large corporate sector. That's the correct answer. Now let's switch our focus to the next question. And the next question is on your screen, as you can see. Let me show you. So this is the question. What does the, I think we can skip this question, not that much important. Yes, planning very, very important. So friends, question is, that which of the following is not a disadvantage of the planning process? So before jumping into the option, let's first understand the question. The question asks which of the following is not a disadvantage. Means 3 options will be describe the problem with planning, that means disadvantages, and 1 option will describe something that positive about planning. So first of all, you must understand the question. The question is asking which of the following is not a disadvantage, which means three options will be there which will describe the problem with the planning, that is the disadvantage, and one option will describe something positive about planning. So our job is to find the one that is not a disadvantage. Option number A, analyzing means planning, planning may lead to rigidity. So what do you think? So let's start with option A. Planning may lead to rigidity. It means when organization make detailed plan, they may stick too much to them. That is called rigidity. This can make it hard to adapt when unexpected change happen. For example, imagine a clothing brand plan to launch a winter collection in November. Suppose a clothing branch is there. They have planned to launch a winter collection in the month of November. But suddenly the winter season is delayed and demand for summer cloth is still high. So if the company rigidly follow the plan, they may lose sales instead of adapting to the market. Right. So what do you think? This is incorrect answer. Right. This is a kind of disadvantage. This is the disadvantage. Right. Option number B, planning foster creativity, right, and innovation. What do you think? So basically creativity and innovation means coming with new ideas and thinking outside the box. Planning on the other hand usually set fixed rule and guideline to follow, right? So planning, they set fixed rule, planning set fixed guideline. For example, a tech company like Apple, a tech company like Google, right? So they encourage employee to experiment with a new idea, but if they are forced to follow a strict plan, they may reduce innovation. Why this is not a disadvantage? Because the question asks for a statement that is not a disadvantage of planning. So planning actually limit creativity. It does not promote it. So this is not a disadvantage. So it is the correct answer. Right. So option C, planning can take significant time and become expensive. So basically planning involves research, analysis, meeting, discussions and documentation. All of these require times and efforts and money. So if the company want to open a new factory, they need to conduct market research, hire consultant, create business model, get legal approval. So why is this a disadvantage? Because planning consume a lot of resource. So this is a disadvantage. So this is not a right answer. Option D, planning might give a false impression of the organization strength. Yes, sometimes when organization makes big fancy plan, they feel overconfident. This can make them ignore risk and assume everything will go smoothly. For example, suppose a startup is there. Suppose a startup is there and a startup plans to expand to multiple cities. Suppose if this startup is planning to expand to multiple cities, right? So on paper everything looks perfect, but in reality they fail to analyze the challenges and their business struggle. So if the planning is not realistic, it can mislead the company into making bad decisions. So this is a disadvantage. So what we learned from this discussion is that planning have some disadvantages like rigidity, time consuming and expensive, false impression of strength. And what about creativity and innovation? So this is not actually a disadvantage, right? Now let's look at the next point. The next question is this question, this is a numerical based question which have been asked in the examination. So basically our session is a blend of numerical and theoretical question. You can see 105 pages are there and some more questions are there which I have not added. So basically almost 100 questions have been added in this particular PDF. If you want to get access to this PDF, you can enroll in our ABFM PDF plan. Please install our app provided in the description section, and in the app you can search for this ABFM PDF plan where you will get the detail. Now let's move forward. So friends, basically let's understand what the question is asking. A spot exchange rate, you can see a spot exchange rate for USD is rupees 83. Risk free interest rate in India is how much? 9%. And risk free interest rate in US is 3%. Time period is how much? 2 years, right? So the question is what will be the exchange rate at the end of second year based on interest rate parity. So first of all, we will use the IRP formula, that is interest rate parity formula. What is the formula? The formula say that let me write down, forward rate is equal to a spot rate multiplied by 1 plus R India divided by 1 plus R USA to the power n, right? Now let's analyze all the option and find the correct answer. So first of all, option A, 104. Okay. So first, what is spot rate? 83. What is R India? So basically, what is the rate exchange risk-free interest rate in India? 0.09, and 1 plus 0.03 to the power n. What is n? N is the second year, right? N is equal to 2. So basically, if you do the calculation, it will be nothing but 83 multiplied by right. So if you multiply it by 1.09 upon 1.03 square, so this will give you how much? This will give you almost 83 multiplied by 1.12, this will give you almost 104, right? So this is the forward rate. So the correct answer is option number A, that is the forward rate 104. Why other options are incorrect? I think you understand it, right? So basically whenever this forward rate is asked and a spot rate is given, so you have to apply this formula. You just remember this formula, right? And higher interest rate leads to currency depreciation in the future. So INR has a higher interest rate, as you can see it is 9% interest rate as compared to the USA, which has only 3% interest rate. So it will depreciate, INR will depreciate in the future, right? So that is the correct answer to this particular question. Let's shift our focus to the next question that we have. So the next question, as you can see, very good question, and this question is asking you that why are SPAC so popular? How do they compare to IPO, right? So basically, which of the following is not an advantage of going public through SPAC merger compared to an IPO? So first option says that SPAC are faster than IPO, right? Faster execution time than IPO. What do you think? So the fact is that a traditional IPO, it takes 12 to 18 months because the company has to go through detailed filing, regulatory approval and roadshow. But a SPAC merger, it only takes 3 to 6 months. Imagine you want to open a shop. So if you go through IPO way, you take months to find investor, complete paperwork and get approval. But if you go through SPAC way, you partner with someone who already has a ready to use shop. So you can start quickly. So yes, SPAC are much faster than IPO. Yes, this is correct. Now option number B, SPAC sponsor provide access to seasoned business and financial expertise. So what about this? The fact is that if we talk about this SPAC, what is the meaning of SPAC? I think the full form, right? So basically SPAC mergers, so basically if we see, SPAC are usually created by experienced investor. So those investors who have experience, SPAC are created by CEOs or financial experts. They help private company navigate the public market. Through SPAC, private company can navigate the public market, right? And attract investor, avoid mistake. For example, imagine you want to start an online business but don't know digital marketing. So if an expert entrepreneur joins you and help with the funding and strategy, you will succeed faster. That is exactly what SPAC sponsor do for company, right? That is what is done by the SPAC sponsor. So yes, this is the advantage of SPAC. Option C, this is called a special purpose acquisition company. Now let's look at the next part. That option C says that SPAC merger involves significantly higher regulatory oversight as compared to IPO. So the fact is that SPAC have less regulatory oversight, less regulatory scrutiny. IPO requires detailed prospectus, right? Prospectus should be there. IPO requires audits. IPO requires SEC review, which takes months. But SPAC skip most of this because they merge with an already public company. So for IPO, you will need full license. Suppose you are opening a restaurant. So if you are opening restaurant through IPO, you will require full license, menu approval, health checkup before opening. But if you go through SPAC, you take over an existing restaurant with approval already in place. Option D, SPAC merger allow upfront price discovery through negotiation, which is beneficial in unstable market. So friends, in IPO, the share price is decided last minute based on the demand. Try to understand. I'm explaining each and every option. What happened in IPO, that the share price is determined last minute. It is last minute determination of the share price. Based on what? Based on the demand, right? In SPAC merger, what happened? The price is negotiated upfront, right? So for example, suppose you are selling your house. If you are selling your house through IPO, you list your house, right? And the price is decided, right, based on the last minute offer. But if you go for SPAC option for selling your house, you lock in price, price is locked earlier, right? With the direct buyer, avoiding markets ups and downs. So SPAC is not susceptible to markets ups and downs, not vulnerable to the markets ups and downs. So option number, which is the correct answer? So this is the correct answer. This is correct answer, right? Have to season business often loss in new hire. So this is not the correct answer. That is our C is the correct answer. C is the right answer. So what we learned from this discussion is that one must know the difference between SPAC merger and IPO. Let me summarize the fact for you. So first of all, on one side let me write down SPAC, and other side let me write down IPO. So SPAC are faster, right? SPAC experienced sponsor provide guidance. So whoever is the sponsor, they are experienced one. In SPAC, less regulatory oversight. Regulation oversight is not that much. And price in SPAC is pre-negotiated, right? Price is pre-negotiated, reducing uncertainty. right? So I hope that makes sense to you. How do we compare this SPSE and IPO? Now let's see one numerical based question here. Let's see one numerical based question to make our concept more clear. I hope we have done this question earlier, that what is PSC. No need to go through it again, right? We have already done it, isn't it? We have done this question earlier, no need to go it again. Now let's see the next question that we have. Yes, so question is, which management approach views the organization as a machine and employee as a part, emphasizing the use of technology to increase efficiency and focusing primarily on organization. Let's go through. Option asked there. First of all, option A say human relation school. What do you think? This is incorrect, because this approach focus on employee emotion, right? It focus on motivation, it focus on jobs, right? So basically in this question we will learn how do different management theory view employee. Are they just machine part or valuable contributor? So basically this human relation motion believe that happy employee are more productive. For example, imagine a factory is there where workers are tired, workers are unmotivated. So the human relation approach would introduce breaks, team activities and feedback system to improve morale. So this does not treat employee like machine part. So this is not the correct answer. What about the behavioral approach? So basically this approach goes beyond motivation. It focuses on understanding human behavior in the workplace. It values leadership style, communication, psychology. So suppose imagine a boss is there, right, who shout at employee versus the boss who listen and support them. So basically behavioral management, it focus on training the boss to use a leadership style that boosts employee engagement. So this is not the correct answer. What about classical school? So basically, this approach sees the organization as a machine and an employee as a part that should work efficiently. It focuses on rules, hierarchy, productivity, our employee satisfaction. For example, imagine you a fast food chain like McDonald's. You imagine a fast food chain like McDonald's. So every burger is made the same way every time using a strict system. So workers have fixed role and efficiency is the priority. So yes, this approach treats employee as part of a system, making it the correct answer. What about the contingency approach? So let's see the option number D. This is wrong, because this approach does not believe in fixed rule. It says that management decisions depend on the situation. For example, you can imagine a sport team. So the coach changes the strategy based on the opponent strength. Similarly, business leader adjusts management style depending on the company's need. So basically, let's quickly summarize the fact. So what we have just gone through, human relation approach, it focus on efficiency, it focus on technology and a standardized process. What is the correct answer? The correct answer to this question is, the correct answer is the classical. It focus on efficiency, right? Technology, a standardized process. Human relation focus on employee motivation and well-being, right? And second thing we have is a behavioral approach. It studies leadership. Right? So leadership, that is a behavioral approach, which means it studies leadership, psychology and human behavior. And what about the contingency approach? It says there is no size fit all rule. There is no size fit all rule, right? Management depends on its situation, right? So that is the option. Now let's see the next question. So the next question we have, which of the following statement about angel fund is incorrect, right? So some options are given. Option A, that angel fund invest in early stage business or startup. Let me zoom a little bit. What do you think? Is it correct? Do they invest in early stage business or startup? So fact is that angel fund help business, that is startup, get funding. For example, imagine a young entrepreneur want to launch an AI powered health app. So they don't have enough fund. So a group of angel investors provide money to help them grow. So this statement is correct. Question is incorrect. Option B, angel fund are a subcategory of venture capital fund. So angel fund, comes under VCF, venture capital fund, which invest in new or growing business. They invest in new or growing business, right? So the main difference is that angel fund invest in early stage. Whenever it is angel fund, they invest in early stage of a startup, but VCF invest when the startup has already grown a little. That is the point. In the earliest stage, the difference between angel fund and venture capital fund is that angel fund invest in the earliest stage of a startup, but the venture capital invest when the startup has already grown a little. Let me give you an example. For example, think of angel fund as a school teacher, right? So who help a child in the early year, and VCF like a college professor who guide a student after they have already built some knowledge. Now, so option number C. So this statement is also correct. Option C, corporate body with any amount of net worth can invest in angel fund. No, this is wrong. Angel fund have a strict investor eligibility rule. Only high net worth individual, right, or company with strong financial position can invest. For example, a company with just 5 lakh in net worth trying to invest in angel fund, they are not allowed, right? Option number D, angel fund involve high risk investment. Yes, this is correct, because if the suppose think of investing in a new restaurant in a town. So if the restaurant become famous, you earn big profit. If it fails, you lose money, right? So that is the point. Since angel fund carry high risk, this statement is correct. So what we learned from this discussion is that regarding angel fund, that they invest in a startup, an early stage business. They are a type of venture capital fund. So angel fund is a type of venture capital fund. Not everyone can invest. There are eligibility criteria, and they are high risk investment but offer higher return, right? That is the point. Now let's see the next question that we have. The next question is task management, reporting structure, decision making, part of which management process? Very good question. What about first option, planning? So basically, if we talk about the planning, planning is all about setting goals, right, and deciding how to achieve them. For example, suppose you are deciding to open a new cafe. Suppose you want to open a new cafe. So planning is deciding what kind of food you will serve, the budget, and where to open the cafe. But it does not decide who will do what work and who will report to whom. So here it is task management, reporting structure, and decision making. What about option B, organizing? Yes, this is the correct answer. So organizing is all about structuring the work, assigning the role, setting up a reporting hierarchy. For example, you are running a football team. Suppose you are running a football team, right? So coach assigning player to different position, that is called the task management. So if you talk about the task management, so the role of coach, what does the coach do? So coach assigning player to different position. The second thing is that player report to their captain and captain report to the coach. This is called the reporting structure. So suppose player is there, player report to whom? Captain. And captain report to whom? The coach. This is called the reporting structure. And the final decision making is done by the coach. This is called the decision making. So all of this is a part of organizing. What about controlling? So controlling is about monitoring performance and making correction. For example, imagine a teacher checking a student assignment. If the student work is incorrect, the teacher correct and give feedback. That is controlling. But the teacher does not assign a student role or decide who reports to whom. That is organizing. That is controlling is not the correct answer. What about the leading? So basically, leading is about motivating and guiding employee to perform well. So football captain motivates and encourages the team to win, but he does not assign team role or set the reporting structure. So let's quickly summarize the fact. Planning is all about setting the goals. Organizing is about assigning the task. Controlling is about monitoring and correcting mistake. And leading is about motivating. I hope that makes sense to you. Now let's see the next question that we have of this previous year asked memory based question. The next question is, which of the following activities are included in the job responsibility of a venture capitalist? That is called VC. So option number A, arranging capital. What do you think? Yes, they are included, right? Because VC don't use their own money. They raise capital from big investor like bank, pension fund, right? Or wealthy individual. This is correct. Investing, obviously this is the core role of VC. Once VC has raised capital, they invest in early stage startup with high potential. So you can think of some famous startup like Zomato, Flipkart, Paytm. In their early day, they receive funding from VC to scale up. Now the list about the growing the portfolio company. Yes, VC don't just give money, they guide a startup on how to grow, how to improve operation, how to expand. Obviously they exit the investment. So the correct answer to this question is all of the above. Yes, all of the above is the correct answer. So friends, as you can see, we have more than almost 100 questions are there in the PDF. If you want to bring me the part 2 lecture of this video, please write yes in the comment section. I will understand that you are interested to explain me the part 2 part also. And if you can't any